start the broadcast.
Okay. The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, everyone. Thank you so much for taking the time to be with us today. My name's Bryony Allen. I'm one of the key account managers here at Ironbark Asset Management, and today we're joined by Todd McFarlane, the co-lead portfolio manager of the Ironbark Paladin Property Securities Fund. Now, today Todd will share with us his views on the current drivers within the domestic property space, where valuations are currently sitting, and his thoughts on whether yields are sustainable. Importantly, he's also going to give us an update on what his outlook is for the sector, what we should be expecting for the next 12 months and beyond, and accordingly how he's going to position the portfolio to take advantage of that. Now, I'm very conscious that you've taken some time out of your valuable day to be with us this morning, so we're going to try to keep this webinar to about 30 minutes. So with that, Todd, I might just pass it on to yourself.
Thanks so much, Bryony, and really appreciate you having us today. And I'll run through the slides today, and I really encourage if there is any questions to leave those at the end, but also if there's things that we can help out with down the track, if you have questions after the presentation, please feel free to reach out to me. But maybe if I start on slide 3, here we've just got our sort of team overview, and really 2 key points here. Deutsche Asset Management is committed to Paladin's long history in domestic property securities. We leverage our global footprint, which ensures that Paladin has a senior and well-resourced team with unique insights from the breadth of our platform. Deutsche, as a business, has more than 1 trillion under management across active, passive and alternatives. I sit within the alternatives business, which invests clients' assets across both listed and direct property and infrastructure assets. And just within our global listed property business, we manage more than 10 billion in AUM, most of which is sort of AUM within the US. We have a senior team of 3 investment professionals, which is larger than most peers. And as I said, it's sort of that global footprint that allows us to sort of make sure that we have a well-resourced team. Chris Robinson and I are both co-lead portfolio managers of the fund, and Eloise is a senior analyst within the fund. And on average, we have about 16 years of industry experience. We have on-the-ground and global support teams behind us, which ensures that, when we're spending time day to day, we're really just spending that looking for new investment ideas for the fund. We're not doing the trading ourselves, we're not doing compliance, we're not chasing up people across or paying bills. It's really just sort of productive time looking for investments for the funds. So I take you to slide 4. Paladin is a true-to-label real estate securities offering, and we have a differentiated strategy that we expect will deliver superior returns. We are a team of specialists, and our strategy is to offer the market 3 alpha engines, if you like. We have high conviction across the large capitalisation REITs, and these positions often test the 10% active weight limit. We have a specialist and strong focus on small capitalisation REITs, which are an important part of our strategy. Eloise Blake, her sole focus is on small caps, and it's finding that hidden value in small cap stocks, which have exposure to sort of compelling different asset classes. And it's sort of, we'll go into more detail later, but it's some of those asset classes that are, they have a high yield, they have a better lease expiry, and they're attractive, and we're looking to partner with those companies over the longer term. The third engine really is tactical international investments. Here we leverage our global on-the-ground investment teams to flag to us interesting opportunities for the Paladin Fund. It's tactical in nature and can be a maximum of 10% in the fund. Since we introduced it 4 years ago, we've added around 225 basis points across 9 investments. So we think that's quite a good record. If I just take you to slide 5, Here's the alpha contribution of the 9 international investments. The fact that we haven't had a negative contributor to date is testament to the global team's ability to identify and flag these opportunities. And this has been really during a time where we've actually had quite a strong return prospect for Australia. So the fact that the stick with which we measured these global opportunities was quite hard. So look, going forward, if we think the total return for the sector in Australia is more moderate or more through cycle, then the opportunity to ramp that engine is greater. And we see that as a key plank of our strategy. But take you to slide 7. We've shown the performance of the AREIT sector over 2 periods. You can see the AREITs have delivered an average annual total return of 6% over the last 14 years, and that's underperformed the market, which delivered 8.2% annually. It's important to note, though, that 6% total return includes the significant drawdown in performance that the AREIT had in 2008, and that was as much as negative 55%. Since 2009, the sector has delivered a healthy 12% per annum and substantially outperformed the market. On slide 8, we show some of the key drivers for this strong performance. The environment has been quite favourable for property valuations since 2009, in combination with good fundamentals and long duration leases. The steady decline in interest rates and long bond rates saw capital chase property assets globally. Transaction volumes have really sort of risen to last cycle peaks, as they're shown in the top right chart there. And asset values rose as investors driving the asset yields down across all subsectors, as shown in the bottom left. While we are now back, I guess, at last cycle lows in terms of those asset yields, it's important to note that the interest rate levels are now much lower, and therefore the spreads to interest rates are far higher and more comfortable in our view. Finally, you can see on the bottom right, AREIT earnings have shown steady growth with no major disappointments, whereas the wider market has really been sideways to down over this same period. So that's driven a lot of people looking at property for that reason. If we go to the next slide, on slide 9, I wanted to quickly just point to the year-to-date performance of the retail REITs, down 4%. It is the logistics and fund managers whose performance has benefited greatly, up 19%. This is a reflection of the market's increasing concern of the outlook for retail, both cyclical and structural, and further, Amazon's entry into the Australian market later this year. So we'll see how that goes, and I'll touch a bit on that a little bit more later. Secondly, the sector is dominated by some large traditional asset classes: retail, office, industrial. In fact, retail is about 60% of the sector. But increasingly, we are seeing more of these alternative asset classes being listed, including childcare, storage, retirement landlords, and even service station REITs more recently. These start out as a new IPO and as a small cap company. We've been quite active investing in small companies, as you can see down the bottom. Their performance has typically been more consistent than some of the larger traditional asset classes. Slide 11 just shows you our forecast. Look, we forecast 6.5% total return for the AREIT sector over the next 12 months. That comprises a safe 5% dividend yield and a 1.5% upside to our detailed price targets. While the return outlook, as we forecast it, is more modest than maybe recent years, we think this remains relatively attractive in the current environment. Slide 12. The chart shows that the AREIT sector currently trades at a 25% premium to asset values, which is pretty much in line with the longer term average. There are a number of reasons why the sector deserves to trade at a premium. Many of the AREITs have active businesses which do not have an asset value, but generate income for the vehicle, and these would include sort of vehicles or businesses like funds management and asset and development businesses. Secondly, we think there is real value in investing in vehicles that have professionally managed, diversified asset bases. You can access liquidity daily, and there are none of the same friction costs, such as stamp duty, that you might otherwise have to pay to get access to the defensive income streams. Next slide, slide 13, shows that the current property asset or cap rate for the sector is 6%. This is implied by current share prices, and we back out the value of their active businesses. The 6% implied asset yield is 3.6% above the current long bond rate of 2.4%, which is well above the through-cycle average of about 3.1%. This gives us some comfort that the market's not pricing in at this stage what might be considered trough long bond rates, and factoring in sort of 50 to 60 basis points increase in this rate. Slide 14, we're often asked, what are the implications of a rising long bond rate for the sector and its asset values? It has been an extended cycle, no doubt, and may go on for some time yet, with consensus still placing some weight on further rate cuts. But there is no doubt we have likely seen the best of interest rate cuts. If lower interest rates drove higher asset prices, it follows that in time higher interest rates will drive asset values lower. But as we noted in the prior slide, we think the market's already factoring in around 60 basis points of expansion in the long bond rates to around 3%. Anything above that, we expect it will start to have a small impact on asset prices. However, it is important to note, that we've been quite conservative in our valuations for the REITs. For instance, we still use a risk-free rate of around 4.5%, considerably above the current long bond rate of 2.4%. Now, I'd further highlight that when we analyse recent transactions as a signal for where asset values will head, we note that the average asset yields in valuations are far above those implied in recent transactions. 20 Bridge Street in Sydney, which is an office asset, for example, sold on an initial yield of just 4 to 4.5% recently. That compares to Dex's average cap rate of 6%, which means there's implied asset value upside for these. Slide 15, we see the risk to another 2008 style pullback in REITs as being quite low or very low. We know board and management teams have been quite conservative this cycle. They've disposed of non-core assets, they've lowered the sector gearing and maintained sustainable payout ratios. But if I cast my mind back to 2008, really the predominant reason for the pullback and deeply dilutive equity raisings that destroyed so much shareholder value was driven by two factors. Firstly, many of those REITs had ventured to buy offshore assets late in the cycle to find growth where they had no competitive advantage, and were buying off very experienced property investors who had appropriately deduced that risk was being mispriced. Secondly, a lot of this offshore expansion was funded by local Big Four banks on extremely low margins. But with these low margins came extremely restrictive debt covenants and a short tenure of the debt, which brought, when the cycle slowed, it brought them into a lot of trouble. We know at this time that the AREITs have used this later cycle to divest of lower growth non-core assets, to de-gear their balance sheets, and to blend and extend their debt sources. The debt maturity is longer, and given Australian banks are not majority lender to the AREITs this cycle, they don't have the same leverage with the AREITs to force them to raise equity, and it would take a serious pullback in asset prices to see the sector move through its debt covenants. Slide 16, just briefly, shows why the sector has a sustainable yield with fixed annual rent increases factored into leases, and their portfolios generally have very long leases, providing good transparency on the cash flows for these vehicles. Slide 18, we start we start a quick view on each of the major asset classes. The office sector probably has the strongest fundamentals over the next 18 months, where rents are expected to continue to rise as vacancies are driven lower from improving demand for office space from businesses, but also from stock withdrawals in the major markets of Sydney and Melbourne to residential, but also in Sydney's case, several buildings have been withdrawn for the new metro line. We sort of expect over the next 18 months that rents will continue to rise, but what we're seeing now is that the favourable conditions are bringing on supply. So I think over that time you'll start to hear more and more of developers coming in and sort of pre-selling that space. So you start to see incentives sort of start to flatten out and even rise. It remains pretty tough in Perth and Brisbane, where although the rate of change has improved, those markets continue to deal with very high vacancies, driven initially by the weaker commodity cycle. Supply, as I said, is starting to emerge. It'll slow growth down in time. But while we like the office sector, we believe the strong outlook for the office is priced into the largest office landlord in Dexus Property Group. And we're sort of getting our office exposure through some of the other major REITs who have quality office exposure. Slide 19, the retail subsector. Despite low interest rates and very positive wealth effect from strong house prices, you can see retailer sales growth has remained relatively muted versus history. Really this is due to a few factors, but wage growth has steadily been declining, and this is at a time when energy and insurance costs have been increasing significantly and will continue to. But Australian retailers have also been facing headwinds of increasing competition from large international competition entering the market and offering products at lower prices, driving a cycle of discounting by the Australian retailers in order to drive volume. If you think brands such as Topshop, Zara, H&M, Uniqlo, and in the supermarket space even Aldi, they're tough competition for the local retailers, and they have a far better cost efficiencies in their back end. Both the new competition and the weaker environment place downward pressure on retailer margins, which in turn has actually driven negative lease spreads on releasing and a lot more churn and remixing of those tenants in the centres. But the rent growth across the REITs, as we show on the bottom right, bottom left, has actually been positive, and that's really due to the contracted annual rent increases in leases. And if I take you to slide 20, retail has been tougher for Australian retailers, as we mentioned, but may get tougher with the widely speculated entry of Amazon later this year into the Australian market. Our analysis of what has happened in offshore markets suggests the following. While 90% of retailing still happens at the storefront, net, Amazon's entry means retailer margins will come down for retailers globally. In order to combat Amazon's entry, retailers generally seek smaller store footprints and fewer stores. The capital saved from not rolling out as many stores, they redirect to logistics facilities in their back end and their digital platforms. Some retailers will have fewer stores, and some may just choose to have 10 to 20 large flagship stores nationally in order to drive brand recognition and traffic to their online platforms. Retailers will want to be in the most productive malls in order to establish and maintain brand recognition, so they'll close stores in poorer locations. Really, we expect this will drive increasing bifurcation between your top A-class regional and super regional malls and sort of your sub-regional malls in average catchments with low growth. So you'll see that really sort of make a big difference. We prefer Centre Group over Vicinity based on the quality of assets. Centre in fact owns 15 of the top 20 malls in the country. so far the thematic has driven quite a bit of underperformance for the retail names this year. But it is important to note that share prices already reflect a predominant part of this risk, in our view. For instance, Centre's implied cap rate based on its share price is about 5.5%, which is well above the 4.5 to 4.7% cap rate, which we expect that an imminent sale at High Point Shopping Centre in Melbourne will sell for. Slide 21. We probably don't have to tell you the strength of the residential market, particularly in Sydney and Melbourne, where prices are up quite strongly over the past few years. Given historically low interest rates, stretched affordability, we expect house prices going forward will, the growth in house prices will be much more moderate. We're not forecasting a strong pullback at this stage, but we are expecting prices to flatten and volumes to slow. The rate of change is important. We've also seen China clamp down on capital coming out of China, and state and federal governments in Australia introducing more macroprudential controls to increase taxes on international third buyers, which will understandably sort of slow the market. While there are other motivations for some of these buyers out of China, we're quite conscious that they're actually buying about 25% of our stock in the current market. Slide 22, as we show on the top right chart, as we show on the chart, price growth has been quite strong in Sydney and Melbourne, encouraging both the large cap residential players, Stockland and Mirvac, have used this strong part of the cycle to rebuild their margin buffers and dispose of non-core assets that might struggle in the next part of the cycle. It's sort of, if I look back to the last cycle, there's a lot of asset write-downs when the cycle turned against them, and really those asset write-downs were driven by, they're in some markets that are more sort of, premium sort of markets or holiday markets. Both vehicles, we're comfortable that they're disposed of those sort of assets. They're no longer playing in that space. They're more likely to be very core central CBD or large metro markets. So the debt service ratio is currently around 35%. We know it's actually been higher in previous cycles, but we're conscious that it's close to cyclical low interest rates, which has driven that. That if it was higher, then it would be up around that sort of 40%. Slide 23. Excuse me. We just added this slide just to demonstrate the increasing breadth of the AREIT sector. In recent years, we have seen the IPOs of some interesting REITs, including childcare, healthcare, pub, farm, and even storage landlords. Excitingly, these REITs typically have attractive long leases, they have a high yield, and even lower tenant incentives. We look at these quite closely, and we actually have an overweight to small caps currently. Essentially, some of these companies we identify as having an enduring competitive advantage, and we look to partner with management for the long term on these names. Slide 28 highlights the returns of the fund over various, this one's the positioning. Here we just show, we've got a 6.2% overweight or active weight to the small caps, and a 7.7% underweight. And that's really just driven by our view on valuations, where we see value. You can see that we have one international stock at the moment in the portfolio. We've held that for about 3 or 4 months, and that's delivered, I think per the presentation, about 12 basis points, but more up to date, probably closer to 20, which is good. You see, we've spoke pretty negatively about retail within the large cap space. You can see there that we actually have an overweight to retail. The stocks within that bucket, the way that we sort of categorise them, there are some diversified names. Really our overweight there comes from an overweight in GPT Group and also Viva. So we're actually underweight some of the big, large retail names such as Vicinity and Centre Group. Next slide. This just gives some of the, that's really just an active weight change over the last month, so it's probably not that pausing it. But if you look at the far right, you can see their largest underweights. We've got a Dexter Property Group is the biggest office landlord. We're currently 6.7% underweight that vehicle. So we're keeping our risk on in the portfolio. We have a very strong view that the office outlook is very much priced into that stock. Where we have strong conviction, we're happy to sort of transmit that into the portfolio. If I take you to the next slide, we just look at the fund performance. It really just highlights the fund over various periods. Over 3 years, the fund has delivered a net return of 15.4% annually, which is quite strong. I'd be very happy if my super grew at that rate over the last 3 and 5 years. Slide 30, our final 2 slides before I pause to take any questions. Whilst returns are bound to be more muted, as we head later into the cycle, we see our 6.5% total return as being relatively attractive in the current volatile environment. The sector retains an attractive and sustainable 5% dividend yield, and we forecast about 3.5% average annual earnings growth over the next 4 years. Finally, on slide 31, we have worked quite hard to make sure that we have a strategy that delivers alpha to you over the medium and long term. We hope our senior and well-resourced investment team demonstrates Deutsche Asset Management and Ironbark's commitment to the fund. Apart from interesting property insights for our global analysts, we have 20 dedicated investment professionals that feed ideas to Chris, Eloise and I. They're a source of alpha in the future, and we think that'll be an important part of the strategy over the next few years. We think bucketing our focus into large caps, small caps and international provides optimal time spent on alpha generating opportunities and efficient use of resources and focus. We remain high conviction, we're bottom up and we're liquidity smart investors. And finally, these strategies will see us continue to outperform similar core managers within the space that don't import non-property risks into their returns. I might leave it there now and just open the line up and we'll see if we have any questions.
Thanks, Todd. You have the opportunity to ask questions through the GoToWebinar tool. If you have any questions, please feel free to write them in. Any questions at all? Great, we've just had a question come through here, Todd. We've got an advisor just wondering, given that there has been, you mentioned earlier in the presentation, some new IPOs to the sector. It's obviously in history been a fairly concentrated sector. Do you expect that to change going forward? And I guess I might add my own question onto that as a bit of an extension, and what does that mean for an active manager such as yourself? Would you expect it to be a help or a hindrance?
Sector concentration has always been a problem, and I think it's hard to see that change anytime soon. It's really how your strategy evolves and make sure that you can still offer an opportunity to get alpha in the sector. I think the way we approach it is we should have very high conviction long-term views on some of the large caps, and for this part of the cycle we are very focused on companies that can add value in the next part of the cycle, and so we are underweight the sort of more passive REITs that have had a lot of the tailwinds from the cost of debt coming down, transaction values or asset values going up, but really haven't just ridden those tailwinds without adding a lot more value to their portfolio. And we're favouring vehicles that in the next part of the cycle have an opportunity to develop their assets, they have a business that can develop their assets, and we see that as quite important. In the small caps, and this is because of that concentration of the sector is very important, and as I mentioned before, Eloise Blake sits within our team. She's an incredibly detailed analyst, and her sole focus is to uncover hidden value in those small cap names. So that's, while some of our peers sort of do small caps as well, we have an individual analyst just focusing 100% of the time looking for value in those. We see that as quite valuable because if you think about some of the small caps are actually a small part of the index, but they can actually be a significant part of alpha, and we incentivize Eloise to make sure that she just looks at that. So if I was covering them and I just said, well, this is only 80 basis points of the index, then I might have put less, I might spend less time, whereas Eloise focuses 100% of her time on trying to find that value. We partner with those companies over the long term. And the international is, another leg of that that sort of helps us sort of diversify away from the concentrated index. And we're really leveraging that international platform that we have, and we think that'll be a great source of alpha, particularly over the next few years.
Now we've got a question that's come through just regarding the potential Deutsche IPO. Do you have any comments?
Yeah, okay, so in case you don't know, Deutsche in the last few months sort of announced that Deutsche Asset Management will become its own listed entity. Deutsche will sell down approximately 25% of the vehicle, and I think in time more as they need capital. Really, I see this as actually quite positive. Improved transparency and accountability to the market is a good thing. The IPO means that the asset management business will operate within its own legal and operating entity. And I think, a commitment that employee remuneration is funded from within the asset management business and not contaminated by group events as they occur. So I think that's a good thing. And, in time, the details are still emerging, but in time I imagine that there'll be strong alignment with clients and the fund. Part of our payment will be in asset management stock. So look, I think while it's a change, it's actually a positive change, and it's something that clients have actually been looking for some time.
Excellent. Well, it looks like that's the end of the questions. So I'd just like to take the time to thank you once again for being with us today. I hope you got a good outlook on what to expect from this sector, and please feel free. We have lots of information available. If there are any further questions that you didn't want to send through today, please feel free to send them through to your key account manager, and we'd be more than happy to help you out with that. So with that, I'll let you all get on and enjoy your day. Thank you once again, Todd, for your time.
Thank you. Cheers.